John did make a comment related to the married puts and the collars, and he says, well, how do you sell a call against the married put position if it's shorter term? Well, the same way you would do in any position. Here's a stride position. I'm not sure if this is not Ernie's exact trade, but Ernie's in this position. And let's go ahead and just take a look. We're going to look at one of my positions in the Fusion portfolio. NEM. It's not up a lot right now. Usually I wait for the stock to move up 4 or 5%. But on September 30th, we opened the stock at 42.32. It did decline in price, but it's moved back up to 42.37. At the same time, we bought the March 45 put for $6.25. Now that looks expensive, but what that does give us is a controlled limited risk position for about 150, 160 days out in time. And I have the 45 strike put, so what I maybe could consider is going out to November, maybe 21 days away here, and selling a 45 call for about 90 cents. This is very similar to a collar. It's just not what we call the standard collar position that we sort of reviewed those adjustments, James, and rollout opportunities. This gives us a profit and loss chart similar to a calendar call or diagonal call spread. The reason why it looks skewed is because, remember, the put's out still 147 days out in time. And the graph we're looking at is based on the nearer term where we sold the short call position, which is only 21 days out in time in this case. So we've got a structure where we took the risk down from 5.7%. I'm sorry, from 7.4% down to 5.7%. We have a max return of 3.2 if our stock's trading at 35. That's taking into account not only the premium that we collected for selling the call, but also the remaining value of the put based on the Black-Scholes pricing model of where this put would be priced if the stock was trading right around 45 or at $45 on November 11th expiration. We see it'd be down to 526 theoretical value. So we'd lose $100 on the put. Oh, I'm sorry, that's if the stock's still at 42.37. Let's try that again, shall we? All right, there we go. That's more likely. So we'd have a loss of about $200 on the put. We'd have the gain on the stock, and we'd get assigned at 45 for the return on the position. And that would give us sort of that 3.3% return on the trade. Now, I'm using the wrong date. I'm sorry. But in any case, this is just one of the adjustments that we use here. There we go. That's what I wanted to see. This is just one of the adjustments that we use here against that standard married put position, the most obvious one, selling the call against it. Why do I say I want to wait for it to move up 5% or so in price? Well, that's simply because I can get this premium, this 45 strike or maybe a 47 strike for a better premium, which would likely put me in a position where I don't go into the double loss range. That's not what I want to see when I sell this call against the put strike price. I want to see something more along the lines of this, just like a regular covered call, but it doesn't dip back down into the loss area. And Ernie's trade, I think his position was very similar, except for his was on LRN, which is stride learning. And I think he had a similar price of around 42.50. And he bought a 45 put for March as well, if I'm not mistaken, but it might have been the 46 put, but we're going to use the 45. He's already rolled it up twice, actually, if I'm not mistaken. And he had a lower price. He was about 5.85. Well, of course, now the stock's up near 46.56. Now he moved this put up twice. And now he's sold also the November, I think, yeah, I might have sold November, but I actually think it was a different expiration, might have been today's expiration. But in any case, what am I looking at? Well, now the stock's up at 46. It's up about 10% from where he got in at 42.50. We can sell the higher strike call above the put strike price. And that gives me more along the lines of the graph that I want to see in this case, where yes, I still have a loss, but it's down to only about 1.5%. I believe Ernie's position is actually bulletproof, where it has no risk to the downside. Still has a potential high profit here at his strike price of his call. but it doesn't go negative. Yes, it still trails off just like your standard poor man's covered call or diagonal calendar call spread. But this is how you sell the shorter term calls against it. We want to wait for the stock to move up in price. And then we're going to look to sell a higher strike call from when we got in and the put strike price for a good premium. And that gives us the graph that we want for the structure. Now, all of this, by the way, you can get at any time. Just the basic introduction to the married put structure and that income method number 1 we just showed. Just head on over to radioactivetrading.com. Just put in your first name, last name, and email address and click Get the Sketch. That is a free 9-page white paper that walks through the pros and cons, the reason that this was developed in the first place by Kurt Frankenberg, and a concept, an example of income method number 1 on a trade that he did many years ago. Of course, we just saw an example of what could be done with that one of the 12 income methods here. And what I mean by 12 income methods, well, again, that full course, the blueprint, walks through the initial structure of the trade. Actually, I should do it over here. The blueprint walks through the initial structure of the trade to control risk on the position, keep your risk to single digits between 4 to 6%. And then there's 12 different income methods that can be used against that structure if the stock's moving up, if the stock's stagnating, or if the stock falls in price, so that we can generate income, lower that initial risk, and potentially bulletproof the trade, which means have no risk to the downside and still unlimited upside potential profit or ability to still generate more income. Going back to what Anthony said, if I have a position, rather than that, let me close out some of these windows, folks, but if I have a stock that I like, that I'm planning on trading for a few months or several months out in time, I'm setting it up as this married put structure and doing the shorter term income methods in between. If I think I'm in a market where the market's hit a bottom and is starting to turn, it looks like it's starting to turn, and I just want some income for maybe a 15 to 20-day trade, that's when I typically use the standard caller, again with the hope of being assigned the short call for max return, keeping the losses to single digits for a short-term period, 3.5% if I'm wrong and the market collapses again and goes below the put strike price, or maybe re-bracket the collar if the stock stays within these ranges. That's a different type of trade to me. It's a shorter term. I'm not planning on continuing to roll and adjust the short collar here, standard collar, I should say, month by month by month by month. If that was my goal and I had a longer-term bullish outlook on the stock, I'm likely trading it as the married put to leave the upside open to begin with, but to have the proper structure to use the 12 different income methods to be able to adjust it in different market conditions and continue the trade for a longer period. Now remember, one of the benefits, of course, of the longer term put in place, even though it's more expensive, even though I'm looking at risks of 8%, 7%, or 6% instead of 3% or 3.5% on the standard collar, that 7-8% risk is for 5 or 6 months out in time. The 3.3% risk is for 14 to 20 days out in time. When you buy the option farther out in time, you're paying higher the price, but you're paying a lower annualized cost. The option that is 6 months out in time is not 6 times the cost of the near-term option with the same strike. If you buy a put option month by month by month by month, rolling in a collar, you're going to have a higher annualized cost. That's why in both situations, we like selling the call against it shorter term, 20 to 30 days out, because when we sell 1 week out, 2 weeks out, or month by month by month, we get a higher annualized return than selling a 6-month out call or 6-month out put in those cases. So you just want to keep that in mind. That's one of the 3 core principles of radioactive trading and how it applies to the structure that we use and the income methods as well. The 3 core principles, of course, are forcing an ideal size trade, so you're not taking on too much risk that you might risk with a leveraged position in uncertain markets. The at-the-money bell curve, which shows us that we want to be selling premium that's closer to at the money, where the extrinsic value swell exists. We want to buy options in these ranges, out of the money or in the money. And the best single-digit protection on the married put comes by buying a put that's slightly in the money and further out in time. Well, shorter term would have a lower risk, but to get the benefit of the radioactive decay line or the time decay curve, core principle number 3, I would be buying out here 160 to 120 days out in time, rather than buying here where the time decay is rapid, 45, 30, 15 days out in time. But in the structure of a collar, I'm okay kind of throwing that money away because it's a shorter term trade that I'm looking to get 2.5, 3% return on in a 15 to 20 day period with our standard collar position we just mentioned. All right, well, just wanted to cover that up there. So that's how we do some of those. But again, remember, you can check that out at any time. Just go into the Married Put tab or head over to radioactivetrading.com and you can check out the sketch there as well. Just get a free 9-page white paper that introduces the proper protected structure and income method number 1.